Welcome all, I'm your host Deko Mohammed. Today we want to focus on financial management, cost of capital, specifically weighted average cost of capital. We want to see how we compete weighted average cost of capital. I still remind you, please subscribe, like and share for more free lessons. Here on the board I'm having a question of which I like to illustrate. The question goes, we are told the current capital structure of Ahadi Limited is given as follows. We have the shillings in thousands. We have ordinary share, 10 each, 30,000. 10% debenture, 15,000. Then we have 12% preference share, 20 each, 5,000. Total 50,000. Additional information. Number 1, the current market value of ordinary shares and preference shares is 50 and 30 respectively. Number 2, the debentures are irredeemable and have a market value of 120 per 100 nominal value. Number 3, the most recent earning per share EPS of company is shilling 6. The company currently adopts 60% dividend payout ratio as its dividend policy. However, the firm's future dividend are expected to grow at a rate of 7% each year at the foreseeable future. Number 6, corporate tax rate is 30%. We are told required the company's weighted average cost of capital WACC using market value weights. For you to compute the weighted average cost of capital, you have to know the formula. Normally, weighted average cost of capital is equal to, we normally take the weight multiplied by the cost of equity plus the weight multiplied by the cost of preference share plus the weight multiplied by the cost of debentures. So we are going to get the weight multiplied by the cost of equity, weight of equity plus the cost of equity. Then we are going to add the weight of the preference share plus the cost of preference share. They are going to add the weight of debentures plus the cost of debentures. This will give us the weighted average cost of capital. And normally, for you to get the weight, we take the total, we take the individual market value, then we divide with the total market value. The individual market value over the total market value. And how do you get the market value? For you to get the market value is equal to the number of ordinary shares, then you multiply by the market price per share. Because of space, let me shorten it. Let me say number of ordinary shares. We multiply it with the market price per share. For you to get the market value, you take the number of ordinary shares, then you multiply by the market price per share. And how do you get the number of ordinary share? Number of ordinary share, for you to get the number of ordinary share, we take the ordinary share then you divide with the bar value. We divide with the bar value. That's all about the weighted average cost of capital. For you to get the weight, we take the individual market value. For this market value, then we take the individual, then we divide with the total. We divide the total market value. Then, for you to get the market value, you take the number of ordinary shares, then multiply by the market price per share. For us to get the number of ordinary share, we take the ordinary share, then we divide with the bar value. And remember, for us to get the cost of equity, we normally take the dividend price per share, D0. Sometimes it may have a growth rate. If it does not have the growth rate, it just be D0 time over B0 times 100. This is zero growth rate, zero. But for our case, if it has growth rate, then we grow that dividend. We take 1 plus G, D0 over 1 plus G, then we divide it with P0, then we add plus G, then multiply by 100. This for the case of growth. If the dividend is going to grow, for our case we are going to use this. But if it does not have a growth rate, we use this, the formula. Then for us to get the cost of preference, we take the dividend DB, this is the dividend per preference share, then we divide with the market price per preference share, then multiply by 100. The dividend preference share over the market price per preference share, then multiply by 100. And for us to get the cost of debt, we take the interest, then we divide with the P0 per the market price per debenture. This interest is subject to taxation, 1 minus T, then by 100. So if we can begin with this cost of equity, let's begin with the cost of equity. We say that cost of equity is equal to, we take the D0 into 1 plus G, then we divide with the market price per ordinary share, then you growth rate, then multiply by 100. We add the growth rate, then multiply by 100. For our case, from the question, the D0 we are not being given. We don't have the dividend price per share, but we can get, because we have the earnings price per share and also we have the dividend payout ratio. We are not being given the D0. We need to calculate this D0. From the question, we have the earnings per share and also we have the dividend payout ratio. For us to get the D0, we take the earnings per share, then multiply by the dividend payout ratio. The dividend payout ratio. Because you can only pay the dividend out of the earnings you have earned, out of the earnings. And in this question, we don't have the dividend price per share, but we have the EPS and also we have the dividend payout ratio. So we can take 60, the earnings per share is 6. From the question it is 6. Then multiply by 60%, 60 over 100. So if I take my calculator, 6 times 60 over 100, 6 by 60 over 100, I'm getting 3.6. 3.6. Now, since also in additional information number 4, we are told that the company currently adopts 60% dividend payout ratio as a dividend policy. However, the firm's future dividend are expected to grow at a rate of 7%. We have the growth rate at 7%. Our growth rate is 7%. G is 7%. Now we can apply the formula. Our D0 is 3.6. Then 1 plus 7%. 7 divided by 100 is 0.07. Then you divide this with the market price of the dividend. In additional information number 1, we are told the current market value of ordinary share is 50. Now we divide with 50. then we add the growth rate of 0.07, then multiply by 100. So if I take the calculator, 3.6, remember this will come to 1.07. 1 plus 0.07 will come to 1.07. So we take 1.07, then multiply by 3.6, then we divide with 50, then add 0.07, then multiply by 100. I'm getting 14.7. Then to the nearest one decimal place, I'm getting 14.7%. 14.7%. This now is the cost of equity. Let's now go to the cost of preference share. Cost of preference share. Cost of preference share. Remember that the cost, we said it is the dividend per preference share. We divide with the market price per preference share, then we multiply by 100. This one, the growth rate does not affect the preference share. The dividend by preference share, we are going to get from the structure. We are going to get from the structure 12% of the bar value. The DP is 12% of the bar value, which is 20. Now our DP is 12% by 20. Then the market value of the preference share is 30. From additional information number 1, we are told the current market value of ordinary shares and preference share is 50 and 30. So 30 is for preference share. Now we are going to divide with 30, which is the market value per preference share. Then you multiply it with 100. Multiply by 100. Now this is going to be 12%, 12 over 100, then multiply by 20, then divide with 30, multiply by 100. I'm getting 8%. So the cost of preference share is 8%. Our last cost is cost of debt. Cost of debt. We're going to take the interest, then we subject to taxation, we divide with the market price per debenture, then we multiply by 100. Now, from the question, interest, we can get the interest by multiplying the bar value with this percentage, 10% with the bar value. We are told in additional information number 2, the debentures are irredeemable and have a market value of 120, 100 nominal value. So nominal value is same as bar value. That means the bar value is 100. So we are going to take 10% of 100 as our interest. 10% of 100 as the interest. Then the market value is 120. Now this is the 10% of 100. That is going to be the interest. Then we divide with 120, which is the market value per debenture, 120. Then subject to 1 minus. Tax is 30%, which is 0.3. Then you multiply by 100. So if I take my calculator, I get 10% of 100. Then I divide with 120. Then 1 minus 0.3 is 0.7. Then I multiply by 0.7. Then times 100. So I'm getting 5.83. 5.83. Now I have the cost for equity, we have the cost for the preference share, we also have the cost of debt. Now for us to get the weighted average cost of capital, we need to get now the weight. Since we have the cost of equity, cost of preference, cost of debt, now we need to get the weight. And we said for us to get the weight, we take the individual market value then over total market value. And for us to get the market value, we take the number of ordinary shares by the market price per share. Now, let's get the market value first. Market value. And we said market value is the number of ordinary shares by the market price per share. Number of ordinary shares is the ordinary share per over the bar value. if you were to get the if you were to get the number of ordinary shares of ordinary share, you take this ordinary share which is 30,000, then you divide with the par value which is 10. Now allow me to wrap this middle part so that I illustrate so that I show how we can get the weights. Remember, we still need this. This cost. I can write them there on top. That our cost of KE, we have gotten it as 14.7%. Then the cost of preference is 8%. Cost of preference is 8%. Then lastly, the cost of debt is 5.83. Cost of debt is 5.83. Now I can wrap. We show how we can get the weights. We can get the weights. We need to get the number of ordinary. We need to get first the number of ordinary shares, and we say that for us to get the number of ordinary shares, we take the ordinary share, we divide with the par value. From this question, the number of ordinary shares for ordinary share is 30,000. We are going to divide with the bar value of 10. Now you can see, now we are getting the market values. Market values. Let's start with the ordinary share. We can start with the ordinary share. And we say that we take the number of ordinary share, then divide market price. And for you to get the number of ordinary share, we take the ordinary share over par value. The ordinary share for this is 30,000. It's going to be 30,000. Then you divide with 10, which is the par value. Then you multiply by the market price per share. The market price per share of ordinary share is 50. That we have gotten it from additional information number 1, which is 50. Multiplied by 50. Now if I take my calculator, I take 30,000 divided by 10 multiplied by 50. I'm getting 150,000. Remember, these figures were in thousands, so it's going to be 150 million. 150 million. Since the figures were in thousands, so it's going to be 150 million. Now, that is the market value for ordinary share. Let's get the market value for debenture. Debenture. We first get the number of ordinary shares. We say we take the ordinary share of the debentures, then you divide with the par value. From additional information number 3, we are told, number 2, we have the bar value as 100. Remember, nominal value is same as bar value. So we take 15,000 divided by 100, then multiplied by the 120, which is the market price of debenture. Now, if I take 150, it was 15,000. If I take 15,000, then divide with 100, then multiply by 120, I'm getting 18,000. Remember, the figures were in thousands, so it's going to be 18 million. Lastly, let's get the market value for preference share. Now, first get the number of ordinary shares, which we take this 5,000, then we divide with, we take that 5,000, we first get the number of ordinary shares by taking the 5,000 divided by the bar value, which is 20, then multiply by the market price per share, of which it is 30, from additional information number 1, multiply by 30. This gives how much? If we take 5,000 divided by 20, then multiply by 30, we get 7,500,000. 7,500,000. Now we can get the total market value. total market value. Total market value, of which it is 150 million plus 18 million plus 7,500,000. So if I take 150 million plus 18 million plus 7,500,000, so I'm getting 175 million 500,000. That is the total market value. And we say that for us to get the weight, we take the individual market value, then we divide the total market value. Remember, these are the individual market values. For us to get the market value of ordinary share, we are going to take 150,000, which is the individual market value, then we divide with this total of 175,500. Now let's have a table so that it becomes easier for us to illustrate. Now let's have the sources. You can see here we have sources. Remember, the first source is ordinary share. Next source is debenture. We have the debenture here. Last source is the preference share. We can have here as preference share. After the source, we can have the market values. We can have the market values. The market value. The market value, remember, we have gotten here 150 million. The market value for the venture is 18 million. The market value for preference share is 7,500,000. Then, after getting the market values, we can now get the weights. We can get now the weight. Remember, we said weight, we take the total market value, and remember the total market value is 175,500,000. This is the total market value. For us to get the weights, we take the individual market value, then divide with this total market value. For this case, we are going to get 150 million divided by 175,500,000. So I'm getting to the nearest two decimal places, I'm getting 0.85. Then the next weight is going to be 18 million. We're going to take the 18 million, divide the total market value, which is 175,500,000. I'm getting 0.1. Two decimal places, 0.10. Lastly, for us to get the market value for the preference share, we take 7,500,000, then divide the total market value, which is 175,500. To the nearest one decimal, I'm getting 0.05. Remember, all their weights will add up to 1. If you take 0.05 plus 0.1 plus 0.85, you are supposed to get 1. The weight will be 1. Now, we have the weights, we have the cost. We just multiply it, then we get our answer. Remember, if I to repeat the formula again, I said for us to get the weighted average cost of capital, we take the cost of equity, then the weight of equity. Our next source was debentures. So if we are to go for debentures, so let's begin with weight first. You can begin with weight. Still does not have any effect. The weight of equity, then cost of equity. We are going to add the weight of debentures plus cost of debentures. Then we are going to add the weight of preference times the cost of preference. Now, our weight of equity is 0.85. If I take 0.85, then multiply by, remember, the cost of equity was 14.7, which I have calculated initially before I have wrapped the board. The weight was the cost was 14.7. 14.7. This we are going to add the cost of the weight of debentures, which is 0.1, then multiply it with the cost of debenture, which was 5.83. Lastly, we are going to add the weight of preference share, which is 0.05, then you are going to multiply it with the preference cost was 8. Now I'm getting how much? If I take 0.85 multiply with 14.7, then I add to 0.1, I multiply with 5.83, then I add to 0.05, multiply with 8. I'm getting to the nearest two decimal places, 13.48. 13.48%. That is all about these questions. For us to get the weighted average cost of capital, you need to know how do you get the cost and the weights. Then you multiply it, you add for the ordinary share, for the preference share, and also for the debt. Remember, sometimes growth may not be given. Growth. For our case, we are told the growth was 7%. There are some instances whereby the growth is not given. If that is the case, you normally say for you to get the growth, we normally take the return on equity, which is ROE, times retention rate, times the retention rate. Remember, retention rate, it means, for our case here, 60% was paid. Dividend 60% was paid. If 60% was paid, 100 minus 60 was retained. That means 40% was retained. Now for our case, we could have taken that 40%. Then you multiply by the return on equity, or the minimum required rate of return. That return of equity, you multiply by the retention rate. You are going to get the equity. You are going to get, the growth. But here for our case, we are told we are given the growth. Now, that is symbol of how to get the weighted average cost of capital. Just get the weights of equity, cost of equity. You add weight of debenture, cost of debenture. You also add the weight of preference and the cost of preference. I hope you enjoyed the class. I was your host, Deko Mohammed. I hope to see you in our next classes when we are going to see more videos. Welcome. Thank you.